Okay, good afternoon, everybody. This is Kevin Schmidt. I'm here with Steve Tuttle, and we'd like to start off by thanking you for joining us for today's Krasney Financial Third Quarter Investment Strategy Update. As always, we'll step you through what happened during the quarter, how it affected our portfolios, and how we're positioning the portfolios today for the upcoming quarters. Again, please, if you do have questions, just hold them off until the end of the call, at which point we will do our best to answer them. So, as you can see on the slide, the first slide, if you're following along online, the third quarter on the news side of things, there was a bunch of headlines. The major ones being the continued discussion over whether or not the Federal Reserve would be beginning a taper. It did not happen in the third quarter, and it's still a bit undecided as to when they're going to begin tapering. I think they've answered the question that they will at some point, but again, there's inconsistent communication coming out as to when that will begin. We were experiencing quite a bit of a gridlock coming out of Washington, D.C., and while that did wreak havoc in terms of the volatility during the time that the government was shut down, we are beyond that point, and markets have kind of gotten back to normal. And luckily, the markets did, in large part, turn a bit of a blind eye towards the debacle that is our government at the moment, and it didn't have too much of a drastic effect on things. The last bit that we'll add to that on the news highlights is that the U.S. Economic recovery is continuing, and it is very real at this point. However, as I just mentioned, a few of the headlines, it is fragile, and it is throwing it off track from time to time. On the market side of things, the U.S. stocks continue to perform very well during the third quarter. The S&P and the Dow, just as examples, were up, I think, 18% year-to-date as of the end of the third quarter, just to give you a little perspective on how they're doing. Really, when it comes to Krasney, one of the major aspects that was a beneficiary to our portfolios was the rebound in emerging markets, and that's both on the fixed income and the equity side. Those two asset classes had been underperformers for the first 6 months of the year, but they snapped back nicely during the third quarter, and were major beneficiaries to our portfolios. In addition to that, the fixed income side, bonds, were a contributor due to their positive rebound. Moving on now to the next slide, our assessment of kind of where we're at and where we've come from during the last couple quarters. Again, we did experience a difficult second quarter. There was a lot of choppiness there, due in large part to the Fed coming out in late May and beginning the discussion about tapering, and that coupled with the underperformance in the emerging markets, which I just talked about. However, things have stabilized since that point, and looking ahead, we do see hopefully some more, or should I say, less volatile times. Some of the areas that we're concentrating on at the moment are U.S. equities, and particularly small caps, and where the valuations have gotten stretched this year. And so in that regard, you're not going to see us adding to those positions, but most likely maintaining our current weights, or if we think things are getting way out of whack, maybe pulling back a little bit in those particular asset classes. As I mentioned a few minutes ago, emerging markets did very well in the third quarter, and we continue to have a great deal of belief in those areas. They are a longer-term story, so this is not something that we're going to be too affected on in our decision-making quarter to quarter. We do think that again, is a very long-term growth story, and we're going to continue to be a participant in that story. Our bond portfolios remain tactically underweight to longer-term bonds and to treasuries. Longer-term bonds, as many of you know from talking with us, have more sensitivity to an increase in interest rates. and so therefore we're keeping him on the shorter end of the spectrum. And we believe that in tactical bond funds and strategies that have more flexibility to navigate a challenging interest rate environment, and so therefore that's where we want to be, as opposed to perhaps more just straight corporate bond funds at the time. So with all that being said, I'm going to now pass it along to Steve Tuttle.
Good afternoon, everybody. Thanks, Kevin. I'm going to highlight a few different things that I think give some perspective in terms of how our portfolios are positioned right now. For those of you who are clients, you know, for quite some time we have expressed some concern about the risks in the marketplace. And this chart, I think, goes a long way to explaining why we are somewhat cautious on risky assets like stocks. Well, what this chart is the line is the performance of the S&P 500, and you can see over the last few years the stock market has performed very well, and our clients that own stocks have benefited from that, which is a good thing. But I also think it's important not to let the fact that things have recently been positive in terms of performance, not to get ahead of ourselves or to accept more risk than is prudent at this point in time. And one of the reasons we're cautious is because earnings have not kept pace with the performance of the stock market. So the bar chart here represents the trailing 12-month earnings of the stocks represented in the S&P 500. And I highlighted just the most recent rally in the stock market, which goes back about a year. And what you see is, from the bar chart, earnings haven't grown at all. They've been flat. They've been flat all the way back through 2011, to be honest. But yet the stock market has rallied and marched upward. That, to us, is a cause for concern. I mean, typically earnings need to be rising for the stock market to be rising. And when that doesn't occur, the valuations get stretched. And so that's part of the reason that we are maintaining a conservative bias on stocks. It's not saying that we're selling stocks now. I'm not saying that we are not owners of stocks. What I'm saying is we're cautious. Now, Kevin highlighted a rebound in foreign securities that occurred recently. I mean, one of the things that we pride ourselves on is being diversified in our portfolios, and that leads to owning multiple asset classes in multiple sectors, and generally that adds value in the form of risk reduction over time. Earlier this year, at the end of the first half, when you received our statements at that point in time, the U.S. stocks were performing very well. However, foreign securities, emerging markets, as well as developed economies in Europe and Japan were lagging quite a bit. And this chart shows the black line is the U.S. stock market. The orange or yellow line here, that's the developed markets, primarily Europe and Japan represented there. And the blue line is the emerging market stocks. So if you were about halfway through the year, right at this line right here, you could see U.S. stocks were dramatically outperforming their foreign counterparts. But as we've gone through the year, particularly in the last quarter, particularly in the last section of the quarter in September, emerging markets and foreign securities from developed markets, that gap narrowed. So they've been showing relative outperformance recently, and that's a good thing. And this is what happens over time with securities. Over short-term, security performance diverges. Over longer periods of time, you tend to see securities come back to their more rational levels. So the good side is that the underperformance that was affecting some portfolios in the form of foreign securities, they're now showing some outperformance because those securities have snapped back. And as Kevin mentioned, emerging markets in particular, we think have quite a while to go in terms of improved performance down the road. Now a lot of the talk, certainly at the midpoint of the year when interest rates spiked, but even now the media and the press and a lot of credible research is now flooding investors with information that says bonds are bad. And I'm paraphrasing obviously, but I want to address that here. And part of the rationale behind owning bonds is I mean, there's three main reasons why you own bonds in a portfolio. I mean, one is that you can generate income from bonds. All right, a lot of our clients, particularly retired clients, need income from their portfolios, and bonds are a good source of income in your portfolios. Another big reason for owning bonds is risk reduction, lower volatility. Historically speaking, bonds experience much less volatility than stocks do. And so they do provide much needed diversification for stocks, which provide growth in portfolios typically. So that combination of income and lower volatility are really the reason why you still need to own bonds in your portfolio. Now, in terms of rising rates, that's the big concern in the marketplace. And as we all know, rising rates can negatively affect the prices of bonds. But the other thing that rising rates implies is higher income. So if a portfolio is properly structured, you should be able to weather a rising rate environment without losing much principal. And our goal is to avoid losing any principal over the long term. That's our goal. But as rates rise, if you can maintain principal and then reinvest as bonds come due at higher rates, which would occur in a rising rate environment, investors benefit from that higher income. So the point here is that rising rates, yes, they can create, in our view, short-term volatility. It can depress values of the bond market, but it also has the effect of increasing income to investors. So that's a good thing. And the last point I'll make on on this slide anyway for the bonds is that the media and much of the information which you may receive tends to view the bond markets in general terms, and they tend to equate the bond market with treasuries. Well, the bond market is much more diverse than U.S. Treasuries. As Kevin mentioned, we are underweight U.S. Treasuries. We're underweight longer-term bonds in general. There is a much wider universe of bonds that are available for investing in. And if you are a client of ours, you know that very well. Our portfolios on the bond side include a very diverse mix of corporate bonds. If you have a taxable account, I'm sure you own municipal bonds as well. Income clients may own higher yielding bonds, floating rate bank loans, emerging market debt, preferred stocks. There's a wide variety of bond sectors and ways to invest in them. And that multi-sector approach, again, is a way of participating in the bond market, but doing it in perhaps a more intelligent way and in a way that our portfolios hopefully can weather a scenario where interest rates rise. Now, just the next two slides, kind of graphically depict what we're talking about. In terms of interest rates, essentially there's been a 30-year bull market in bonds. So interest rates have steadily dropped, leading to perhaps a bottom last year. But as you can tell, if you look at a very long-term chart, just because interest rates have moved up doesn't mean that all of a sudden we're going to go right back up to 12 or 14% interest rates. I don't think that's going to be the case. So while it is important to understand where we were and where we are today, I don't think it's prudent to completely give up on bonds for fear of a a rapidly rising interest rate scenario. And in fact, if you look over the near term, chart looks very different. This is a 3-month chart of the 10-year Treasury, and you see that coming after the summer, interest rates spiked. They went as high as just under 3% for the 10-year Treasury yields. That occurred in early September. But since then, interest rates have been pulling back. All right, so that's a trend that we're watching very closely. And movements up or down like this are not uncommon in a volatile market that we're in right now. So as I mentioned, we are choosing to take a multi-sector approach to income and a multi-sector approach to bonds in particular. So with interest rates rising earlier this year, that caused prices in particularly treasuries and longer-term bonds to go down. And really all sectors of the bond market were affected to some extent. But the value side of what we do on the research front is look for opportunities. So when interest rates move up and money floods out of bond sectors, and that's what's been occurring in the mutual funds. Mutual fund bond flows have been very negative. That creates opportunity. And our portfolios are emphasizing credit sectors. What do I mean by credit sectors? Well, areas of the bond market that aren't AAA rated like U.S. Treasuries, where there is some credit risk but less interest rate risk. That's where we're focused on right now. Corporate bonds, bank loans, high yield bonds. These are areas that are of particular interest to us. Municipal bonds. There's been a lot of negative press on municipal bonds. I have another slide where I'll talk a little bit more about them. But to us, at these levels, municipal bonds represent some opportunity. And foreign debt. That's essentially, in our portfolios, we're focused on emerging market bond funds. As Kevin mentioned, they had a rough beginning of the year. They've been rallying recently. We think there's nice value there, and they belong in a well-diversified portfolio. So those are 3 areas that, if you're a client of ours, I'm sure you see them represented in your portfolio. So credit sectors. Here's why we're interested in credit sectors. This is a chart that essentially compares the performance of various bond asset classes during periods of time when interest rates rose. All right, so most recently, interest rates rose. The 10-year Treasury lost about 8% of value. Not good if you were a long-term owner of Treasuries. But if you were invested in short-term corporates, you were actually positive. High-yield bonds, you gained about 9%. Floating rate loans, you gained about 8%. So this, and you can see that this relationship is fairly consistent. And the point of showing this is again to make sure that when you hear negative things about bond market, you understand what they're really speaking about. If they're talking about treasuries, yes, I understand. A lot of interest rate risk. I'm not sure that you should own longer-term treasuries in this market. However, there are lots of other sectors that are also in the bond market that don't that can perform well even in a rising interest rate market, and those are the areas that we're focused on now. Okay, municipal bonds. Well, municipal bonds were hurt by a few different issues. I mean, one, when the interest rates spiked in the second quarter, municipal bonds are bonds. They tend to be higher credit quality. There is some interest rate risk there. Yes, they were hurt by that spike in interest rate risk. But there was further damage done by bankruptcy and default talk coming out of Detroit and Puerto Rico. So there's a lot of negative sentiment on municipal bonds right now. I think perhaps it's overdone. And I would caution investors not to react or overreact to the recent turbulence. And exiting that position right now, exiting the muni bond market right now may not be a good idea over the long term. it does, the idea of saying or rationalizing to yourself, hey, why don't we just step to the side, wait till the news gets better, and then invest? Well, there's a few different problems with that. One is moving to the side and investing in cash essentially exposes your portfolio to no return, and if you account for inflation, it's actually a negative real return. The other thing is, when the news is the worst, that's when, if you're selling at the most depressed prices. And I'm not saying that the muni market can't go lower from here. All we're saying is that if you are properly invested, if you are taking prudent risks and well diversified, maybe stay on the shorter end of the yield curve, avoid certain areas of the muni bond market, I think you can weather this negative news, and in fact, perhaps profit from it in terms of higher yields. So while we do believe that this negative press is probably not going to go away anytime soon, we do think that same negative press and declines have created some very attractive valuations among muni bonds. And the next slide shows a little bit of what we're talking about. I mean, as we know, muni bonds have the major advantage of being tax-free. If you buy a muni bond in your own state, it could be triple tax-free. So usually muni bonds, the yield that you receive will be less than treasuries and corporates. Well, today, that's not the case. Today you can invest in municipal bonds at rates that are higher than treasuries and even higher than some corporate bonds. All right? That shouldn't be the case, but it is today, and to us that's a nice opportunity. So I'll just summarize, I think, what we some of the main points that that we want to get across to everyone right now. It's great that the stock market is up this year. It's a good thing that certain areas which were underperforming are rebounding. There are some areas that are still under some pressure. There are some areas that are still lagging. But one of the most important things, I think, is to keep all this in perspective. And really what it comes down to is try to avoid the temptation to take on more risk in order to achieve higher yields or higher returns. It's easy to get caught up in the fact that, oh, my next door neighbor made a lot of money on Netflix this year, or some other stock that rallied quite a bit. But I think our approach is to take measured risk, and really that's one of the things that I think we pride ourselves on. Right now, we are happy to participate in the upside of the stock market. If you own a balanced portfolio, you do own some stocks, you do have portions of your portfolio that are participating in that. But I think it's also important to recognize that where we are today, this may not persist. It definitely won't persist forever with the stock market going up double digits. So risk management is real important. Another real important thing to consider is portfolio construction. Another thing that we spend a lot of time here at Krasney Financial. It's not enough to buy one or two stocks that you know, the local brokerage firm rate is a buy. That's not a portfolio that we think you will do well with over time. There's too much risk in our opinion. What we try to do is intelligently and based on research and based on understanding our clients' goals and needs, we try to create a portfolio, a mix of assets that hopefully, potentially, have some risk characteristics which offset each other. All right, so we're trying to achieve the right balance between risk and return possibility, or growth and income, and what we do still believe is a challenging environment. And one of the ways of doing that is by properly allocating your portfolio, spending some time so that each component of the portfolio serves a role, and that the portfolio as a whole keeps you on pace to achieving your goals. And the last point that I think is very important is flexibility. With a volatile marketplace like we're in today, we do think it's important to stay away from locking up your money for long periods of time. I think flexibility is very important. We're not going into portfolios and making changes every day, but we have the ability to do so if the situation plays out and we do create or see opportunities, we can react. We can overweight or underweight certain asset classes based on our research and based on circumstances. All right, and so if you've been a client of ours for a while, you've noticed we're not day trading. We're not making very frequent moves, but we do make adjustments, and the adjustments are generally well thought out, and they're disciplined. So when we see opportunities created by the marketplace, we will choose to take on more risk if we think the return is justified, or to take less risk if we think there's an unnecessary level of risk out there. And that's something that we spend a lot of time on. So the final thoughts, aside from all the verbiage about where the markets are, where they're going, is to keep some big high-level concepts in mind. Risk management is essential. Avoiding or trying to avoid significant drawdowns is very important, particularly for retired investors. Portfolio construction. It is important that you have securities in your portfolio that behave differently. You don't want everything moving up and down together. And then flexibility. The ability to make adjustments based on valuations, we think is important. So with that, I will wrap it up. If anyone has any questions, now would be the time. I see someone typed in to outline our thoughts on real estate. So I believe the question would probably be referring to real estate investment trusts, which are a way of investing in the real estate marketplace. REITs are not currently a part of our typical client portfolios. We do have a very small position in REITs in income portfolios. Essentially, but we have followed REITs. We have owned REITs in the past, and we probably will own REITs again in the future. But in terms of the valuation right now, quite honestly, the REIT index yields about 3% with probably low growth prospects. You can buy a basket of U.S. dividend-paying stocks with higher yield and higher growth prospects. And so to us, that's the trade-off, that we prefer to own stock for our growth assets that throw off similar amount of income than REITs. And so that's our rationale for not owning a significant portion of REITs in our portfolios right now. Did anyone else have any other questions? Okay, with that, I'll thank everyone for participating in the call. And as usual, if you have any questions or need to speak to us at all, we're always here and available by phone or email. Thank you very much.
Thank you.